So this is what we did in the last class. Let's just quickly launch it once if we can. Just take you back to the framework. This is where we ended the last class, just as I said, continuation. This is where we ended. So this is the important decision problem of buying and selling. And in the case of options, as you know, the decision problems are a little bit more complicated. Once you get into buying and selling of options, it's not just when you come to the point to remember here is that when you do the listing of decision problems, when we started in our first course, we did just for spot contracts. We did this listing just for spot contracts. But when you come to options, you have the most complicated set of sub-decision problems under this. Okay, that you don't, not only do you need to decide the buy-sell bias, that means when you're trading options, you need to decide whether you're a buyer or seller of options. That's one. You also need to decide whether you're going to be a buyer of calls or puts. Okay, if you decide to be a buyer here under buyer or seller, buy-sell bias, whatever you decide, buy or sell, you have a further decision, which is that you have to decide whether you want to be, if you're buying, you want to buy calls or do you want to buy puts. And similarly, when you decide to sell, you have to decide further, there's a put or call decision to be made. So that's a second decision that you have to make. And here, I think we have them listed out somewhere further down. Okay. Yeah, so this, whether to buy, sell, that's one decision. In the case of options, it's slightly more complicated. Then you have a second set of decisions which you don't have when you're trading spot contracts, which is call or put. Okay, and so this framework, what it does for you, please make sure everybody understands this. Go and replay the video and read the notes, and so that you can understand what's going on. And just give me a second. I'm just rearranging some of these notes. So this framework at this basic stage, please, people should understand this very clearly, how this is arrived at. And because this helps you to, gives you a framework for solving some of the important decision problems. Let me just see where this is. So for some of the classes, I may take some of the notes out of your folders because I may want to ask you certain questions. So therefore, just in case I forget to, I will generally remember to put them back in your folder so you can study them. But okay, I'll make sure I find the notes and put them back in the folder. But I've just taken it out of the folder right now because I may ask some questions and I don't want students to refer to the notes. Okay, so this is your framework, which we have, although I've received some complaints that, you know, we are repeating a lot of material, but I'll just repeat this very briefly. So make sure you understand this. So you have a decision whether to buy or sell options as a first level decision. Second level decision that you have is to decide whether, having decided this, to decide whether to do calls or puts. That is, are you going to be buying this or are you going to be buying this or selling this or that? So this framework helps you to form that view. Okay, this is the eyeball. You take a view on that, and depending on where you're bullish or bearish, you go into a particular box, and then you take a view on the underlying asset, and then depending on your view, you go into another box. So based on those two-step decisions, you get yourself into one of these boxes, and that's what you decide to do. So what we will do when the way we will continue with this class is that that's not the end of the story. So option trading is so complicated that even that is not the end of this story. We are still on this buy, sell, buyer story at this stage. So initially we had to decide whether you wanted to be a buyer of options or a seller of options. And then you decided that, and then you decided to buy you have to further decide on whether you want to be a buyer seller of calls or puts. You decided that. Even that is not the end of this decision problem 4, because there are a couple of other sub decision problems that are involved, okay, which you have to decide in when you're buying and selling options. A couple of other decision problems are involved. Okay, let's look at okay, let's ask somebody. Let's ask Saroni. Can you tell us anything else? Can you give us an idea what other decision problem we have to solve when you're buying and selling options? Can you give us some idea? All right, let's ask Akshita. Can you? Is my question clear? What we have decided that we have taken a decision on. We have taken a decision on the question of whether to sell buyers, to be a buyer or seller of options. We have also taken a decision on whether to be a buyer or seller of calls or puts. So those 2 decisions are taken, but that's not the end of the story for option trading. So there are some peculiar decision problems that have to be solved in the case of options, which do not exist in the case of spot contracts. So what are those other decision problems that we have to solve just within this larger problem? Akshita, any response? Am I audible?
Yes, sir.
Okay, fine. Let me ask somebody else then. Okay, what about Ketan? Ketan, any idea what else we have to solve in the case of options? What else we have to do?
Sir, his mic is not working. He has just messaged us and he's just going to restart this connection.
Okay, fine. No, if somebody's mic is not working, they can respond on chat. I'm watching the chat also. All right.
Okay, sir.
Ketan's mic is not working. Okay, fine. Let's ask somebody else. Let's ask Abha. Abha, can you help us? What other decision problem exists that we still have to solve? Okay. So remember here, I think one of the other pieces of feedback I got was, I mean, sometimes people are finding the class boring because I'm not asking questions, but as I explained to you, that is for saving time. But your CP marking, you know, in the first course in IPM, I was very lenient. I did not, I gave like 3 grades of CP marking. That's 20% of your grade. I gave 3 grades of CP marking, 3 levels. Quantity, no, Ketan is saying quantity. No, quantity is not what, quantity is a separate decision problem, Ketan, because quantity goes here. Remember, buy, sell. I'm talking about just here. There are a couple of other decision problems that will exist in the case of options just underneath this larger problem, which do not exist in the case of spot contracts. Okay, that's what I'm, maybe my question is not very clear, but still. Expiration date, okay, that's good. Expiration date is one of them. Okay, so
Sir, call or put option.
Sir, expiry date.
already discussed. Call or put we have already discussed. Okay.
Strike price.
Strike price, sir. Expiry date.
Expiry date, correct. So Aman, yeah, Aman, Sambhavna, Nikita, Kanika, I think have also answered. So Sachin has raised his hand. Okay, now I've already given the answer, but yes, Sachin, let's hear what you have to say.
The same thing I am saying it also, so I am adding that we are looking for the eye wall. Uh, if we say buy or sell, if we say eye wall is too much, we don't think we can buy. If the expiration date is less.
Uh, yeah, yeah. I got it. I got Ketan. I got your response. Don't worry. I got your response. So okay. One second. Let me just. Yeah. So this is correct. So mainly the answers I was looking for were the idea. The 2 points where.
Sir,
Yes.
sir, is moneyness of the option, that is the intrinsic value, that is also a decision problem.
No, moneyness is not a decision problem. Okay. So let me explain first the right answer, then I'll explain why the others are not correct. Okay. So essentially what I was looking for is that, like, here we have a part in your notes. You'll get this back after the end of the class. Okay. That the additional decision problems that exist in option trading, which did not exist in the case of, which do not exist in the case of spot contracts or cash market trading. So those are that you have to, first you have to buy, this is fine, this exists even in the case of spot contracts. But from here onwards, you start with decision problems that you don't have to solve when you're trading spot contracts, but you do have to solve when you're trading options. So the second level decision, second decision is whether to buy or sell calls or puts. Then the second is, then the other one is where we have, as some of you answered, expiration date, get an answer, and Sambhavna Kanika had also answered, and Sachin also. So which expiry date to choose and which strike to choose, all right? So expiry date and strike. So these are the peculiar problems. I have not opened the TWS today because I have a big PDF also open. Anyway, so we can understand this actually just by looking at, we'll take a simpler case. We'll look at the Yahoo Finance option display. And from there, hopefully we can get an idea. Let's look at, yeah, we'll look at Microsoft options on Yahoo Finance, and then we'll give a good understanding of, so let's look at what is the difference between, we have to be clear about this. Let's open the view chart. So please note your date on the, I think your option trading is starting from next week, okay? Your live project trading, because I wanted to give you guys about, sorry, I wanted to give you guys, I think 5 weeks this time of trading. If you feel you're not ready, we can just look at it. If let's just look at this before I get into this. Slightly administrative matter, but let's look at it. It's still important because you need to feel, you should have some level of, you know, sense of being in control. I think the problem with all these courses is, you know, we are so tight on time. I'm also not satisfied with the level of time, or the amount of time I'm giving you. But what can we do about it? You know, this is like the VBox, like the VBox software. We have to accept whatever is the situation given to us. And let me just try and see where we are. Yeah. So I have given today's. What is today? Today is. Why is this?
21st.
30th November. So you have a little bit of time. It starts from 30th November and it ends. Yes, Sachin, what is the question?
Nothing, sir. I am just telling that we are starting from 30th.
Yeah. We're starting from 30th. So yeah, I don't know why I had put this green here. Okay. Anyway, never mind. So we are starting from 30th and we are ending on. So if let's hopefully we can start from 30th, because if we start on 30th and we end on 24th December, that's a Thursday. Normally we end on a Friday, but since 25 December is actually Christmas, so it's a holiday in the Western world. note that Japan does not have Japanese markets. Tokyo does not shut for Christmas. So if you're a foreign exchange trader and you have positions in on 25th December, you have to worry about the Tokyo market, so they don't start shut on 25th December. But in the Western world, is a holiday, so we can effectively close the project on Christmas Eve. Okay, so that gives us from 30th November. We are basically talking about 1 week here, 2 week, 3 week, 4 week. Okay, so not even 4 weeks actually, less than 4 weeks, because this time we are very tight of, I don't know, for various reasons. Okay, we are not even able to cover the material on time. So we have 4 weeks. So please make a note of that. Please make sure you start the project trading on time. Okay, that's when you do all your live trades, and which count towards your project grade. All right, so let's go back to the decision problem. Sorry for that little administrative, break or detour. So let's look at, so essentially what we are saying is under the buy-sell decision problem, there are actually additionally three extra problems which have to be solved, which exist in the case of options trading, but do not exist in the case of spot contracts. So those additional decision problems is you have to also decide whether to be buying and selling calls or puts. And once you decide one of these, you have to also additionally decide which expiry date, and then you have to decide which strike to choose. Okay, so these are the four problems. Now, coming back, so these are the correct answers in terms of the three additional decision problems that are sitting underneath. In the case of options trading, these are the three additional decision problems that are sitting underneath this decision problem. Okay, so if you look at some of the answers which were not correct, so when, say, Ketan was saying position size, quantity, now that's a separate decision problem at a high level under position size. Okay, so that we treat it as a separate problem. Now, what Utsav was saying was, what were you saying, Utsav? You were talking about moneyness of the option.
Yes, sir. Underlying price.
It's not a decision problem. Remember, moneyness of the option is something like, it's a characteristic of the option. So it's not a decision problem for you. So moneyness of the option is like height of students. Okay. Now, height of students is not a decision problem for you. What might be a decision problem for you is at what height are you going to apply some kind of cutoff? Are you going to make it 6 feet? Are you going to make it 5 feet, 10 inches? That would be a decision problem. Height of students is whatever it is. Okay. So moneyness of moneyness of options is not a decision problem. It's a characteristic of the option, but it will have a role to play in this when you choose your strike. Okay, when you choose your strike, the moneyness will come into play because it will effectively it is connected when we discuss this. So today, mainly what we are going to start with is I just wanted to give a little bit of a background and make sure we understand the comprehensive context. But today, what we are going to focus our discussion initially on is these two additional decision problems and how you solve them. Okay, so if you look at if you go to in the case of option trade, in the case of spot contracts, in the case of spot contracts, if we go back to what we have in this case. I think in your trading this time you have Twitter. Okay, so if you have a look at this, in the case of spot contracts, all you need to decide is whether you want to be a buyer or a seller here. Do you want to have a buying bias or a selling bias? And this is a spot contract, and whatever you decide, you implement it. If you decide to use market orders, then you can straight away implement whatever your decision is. And that's it. There's no further decision to be taken. But in the case of options, that's not the case. That's not true. Because if you have options, we will go to straddle view. And the 210 is the underlying asset price. We'll make it a little bit bigger because you can hardly see anything. Yeah. So in the case of options, suppose you've decided by looking at the eyeball charts, you looked at the eyeball charts and you decided that the direction of eyeball is going to be higher. So you want to go to be a buyer of options. So you decided that basic buy-sell problem. So you want to be a buyer of options. You still have to decide whether to be a buyer of calls or puts. Okay, so it's a second decision problem. Then third, you have to also decide which expiration date, because as you can see, there are so many different expiration dates. Okay, you can choose any of these. So that's a second, that's a third decision problem that you have. And the fourth decision problem is that if you choose, let's say, January 15th, okay, by this time you'll have a fairly good idea as to who the president is. Okay, so one of the things that is clearly apparent is that in India we have a better election system than they have in the US, because our election system is much more secure, and we don't have to wait for for 2 months to find out who won the election. So anyway, so that's at least so in some area we are better than the US, because generally they're ahead of us in every area. So anyway, so let's look at this. So there's the so if you've decided to go for January 15th, okay, by that time it'll be quite clear who is the president. So if you are looking at options for those for that maturity date, you solved your expiration date problem, but you still have one more problem. It's just that even for this January 15th, let's say you've decided to be a buyer, and you've decided to be a buyer of calls. Then you decided to be a buyer of calls for January 15th expiration date. But which strike should you choose? The underlying is at 210. Which strike should you choose? Now here's where the moneyness comes in. You'll notice that most of the option quote software, you look at the shading, okay, because it's 210 here, this is where the underlying asset price is roughly. So they have this kind, most option trading software, you'll notice this even on your TWS, they will have some kind of a shading scheme to show you the in the money options in a different light. Okay, so here they have shaded the in the money calls and the in the money puts. So because the underlying is around 210, just above 210. Now all these calls are in the money. Okay, 175, 180, 185, etc. These are all in the money. They have shaded them so that you have a clearer view of which are the in the money calls. And the puts here, these are the in the money puts. Okay. Please make sure you get very familiar with the kind of language I'm using here. You should be able to quickly, this is just a matter of practice. Everything is practice. Okay. So you should be able to very quickly figure out which is in the money, which is out of the money. All right, so this is where Utsav's point about intrinsic value comes in, the moneyness of the option. Okay, so but this, so when you so you have a fourth decision problem to solve, which is which expiration date. Which strike should I choose? Because you can't buy all the options, you can't buy all the calls. So you have to decide which expiration date to choose, and that's your fourth decision problem. I'm sorry, I meant which strike to choose. So that's your fourth decision problem. All right. So here, this is the point we're trying to discuss. 3 and 4, we'll be discussing it together, right? So these are the two additional problems. Okay. So let's look at them one by one. As far as expiration dates are concerned, right? So we will have this rule for the choice of maturity, tenor. Let's call it expiration date also, so that we know that this is the same. So, Utsav, are you clear that why your moneyness is not a decision problem? Because moneyness is just, it is a characteristic of the option based on the strike and the underlying price. Is this clear?
Yes, sir.
Yeah. So these are the different options. They have different intrinsic values. This is just a characteristic of the option. Now you will have to choose the strike, and the moneyness may have a role to play in the choice of the strike. So that's a different matter, but it's not really a decision problem for you because it's just a given. Based on where the underlying is and the strike of the option, it will have a certain amount of intrinsic value, and there's nothing you can do about it. So if you can't do anything about it, then it's not a decision problem. Okay, decision problems are all cases where there is a choice. You can choose to do either A or B, and generally, they are mutually exclusive. If you do A, you can't do B, and then you have to decide which way you want to go. So that's why it's not a decision problem. So let's look at the first one: expiry date, maturity, tenor. How do you solve that? So this is your third decision problem on the buy-sell just on buy sell. This is your third decision problem in the case of options. So the rule that we have, I'll explain the rule first, and then I'll explain to you why we have this rule. Okay. So in general, please note this kind of writing. Okay, you notice that I use language very carefully, and so that's why you don't have situations like, you remember Siddharth was reading somewhere on the web that options are used for hedging. That statement is not really correct, because options are used for speculation as well. So that statement is not correct. So when you make a statement, you have to be very careful. So because the statement is not always 100% always true, that's why I put this hedging phrase here. I have kind of covered myself by saying in general, so and so should be done. So that if there are certain situations when this thing should not be done, then if somebody comes to me and says, well, you said we should do this, but I said no, what I will say is in response, no, look at what I said. I said in general. That means that there are, so this is a lesson for you even in other areas of your life. When you're talking or writing something, please be very careful. If there is some case where your statement is not true, put a qualifier like this, okay? So that later on, if there is any kind of exception to your statement, you will point to the qualifier and say, look, I never made an absolute statement. I said in general, okay? So in general, while selling options, shorter tenors, let's put the, so this is our basic guideline, all right? So when we come to this decision as to the time, depending on, so what we are saying here is that we have all these expiration dates when we have to choose the expiration date. Now, when we come to this decision problem, we have already solved the larger problem of whether to be a buyer or seller of options, right? Based on our view on the eyeballs. So since we have already solved that view, we already know at this point when we come here, we already know whether we are a buyer or seller of options. So what we are saying in this rule is that if we have decided to be a buyer of options, you generally try to go a little bit longer, okay? A longer means at least 1 month, maybe 3 months, 6 months, even better if you can get longer dated options, okay? So it's longer means definitely under 1 month is not long term. So this is not a very clearly defined period. What is long term? What is longer tenors? But I would say broadly, just at least minimum 1 month. Okay, nothing less than 1 month further out. So that guides you in the choice of expiration date. Okay, if you're a buyer, you try to go long term. If you're a seller, you try to go short term. Short term is ideally, yeah.
Sir, if we take, sir, like you are saying, long-term options, sir, the premium will be high, sir, if we go for like 1 month option or 3 months or 6 months.
Correct. And the premium is high for a given strike. The premium will be higher in the long-term option.
There is, I think that there is more risk because
More risk, but remember when we are going to discuss options, we are going to always try to bring in these two terms, not almost always, that these two terms, intrinsic value and time value. So I just want to check your understanding of it. So you're correct. You're correct in saying that when you go for longer term options, the premium for a given strike, okay? Like if you look at a given strike of, let's say 75, okay? And if you look at the prices of the 75 calls on Microsoft for different maturities, Vipul is correct. For any given strike, as you go to longer maturities, the prices will keep on increasing, okay? So my question to you is, you're correct in that statement. I just want to test your understanding and also everybody else's understanding. So the prices are going to be higher for the longer maturities because of, is it going to be because of higher intrinsic value or higher time value? Yes?
So time value.
Time value, correct. AA is correct. So if you remember in our discussion of time value, when we were discussing time value, one of the things I said was that time value is affected by two things, which is the eyeball, the level of the eyeball, that is the ball input into the option valuation model, and it is also affected by the
Date of expiration.
expiration date, which is the tenor of the option. Okay, and so therefore, what AA has correctly answered is that. So when Vipul's observation, which is correct, that when you go for, if you lock into a particular strike rate strike price and try to observe the prices of options across different maturities for that same strike price, you will find that as you increase the maturity, the price of the option is increasing, the premium is increasing. So my question was, is that increase due to intrinsic value or higher intrinsic value or higher time value? And the answer that AA gave is correct. It is because of higher time value. And I was bringing you back to what I mentioned, that when you have time value of options, it's driven by two factors, the tenor of the option and the eyeball level. Okay, so that's just a quick recap. So yeah, Vipul, you're correct, but this is
Sir, I have one more question, sir.
Yeah.
Sir, one thing I observed while trading that, sir, I have traded Nifty Bank option, and sir, on expiry date, sir, the option price came from 300 to 20.
okay.
And sir, after some time, sir, Nifty Bank, I have buy an option of 25,000 around something, sir, 22 or 25,000, I don't remember it. Nifty Bank option, and sir, the Nifty Bank index break that price, and sir, the premium will be after 2 hours is 420 on that option.
Okay.
Sir, how can, sir, this happen? Like on expiry date, so much premium was there.
So, okay, so the second part of your question, the second part of your narration, that dropping to 420, that part I did not understand very well, but we'll come to that. Let me explain the first part of your answer. In fact, if you just wait, you will get, once I explain this, right now I'm just explaining the rule. And once I explain the reason behind the rule, I think it'll answer most of your questions. And then if you still have something left, we can recap that, your last part, which I didn't understand very well. So just wait for a while. Explain the reason, and then I'll come back to you and see if your questions are answered. Okay, so just wait for a while. So at this point, I'm just explaining the rule that when you have and I was just responding to Vipul's question about the observation, rather, about the increase in the increase in the option premium as the tenor increases, and we established that it's due to the higher time value. Okay. Now, let's just go into the reason why we are giving you this rule, okay? Why am I saying that when it comes to this, you should choose shorter tenors when you're selling options and longer tenors when you're buying options, okay? Now, remember that we have we have an expiration here. This is regarding the Vega part of it. Let's look at the theta part of it here, which I have where the expiration is. Yeah, we'll have it somewhere here, I think. Okay, maybe there's, for some reason, the explanation has got deleted here, but so this is, yeah, it is there. Okay, so we have two reasons for this. The longer dated options have higher Vega, that's one, and lower theta. Okay, higher Vega and lower theta than shorter dated options. So what is the rule that I'm telling you to follow? In general, when you're selling, go for shorter tenors, and when you're buying, you go for longer tenors. Okay. Now, remember, go back to the basic framework for your decision making. Why are you, if you're saying that if you're a buyer of options, you should go for longer tenors, and you're selling, you should go for shorter tenors. Now, if you go for, let's say if you're a buyer of options, why are you buying options? The main reason that you're buying options is, remember that I gave you this framework. If you look at, or if you look at here, we want to go back and launch this. Right, so why are you a buyer of options? Because you looked at the chart, you looked at the underlying asset price chart, the SPY ETF, then you looked at the eyeball chart. Okay. Mainly you looked at the eyeball chart for forming the view on option prices, future movement of option prices. And so eyeball right now is under 20%. And you took the view that eyeball is likely to move higher from here. So if eyeball moves higher, then ceteris paribus, the prices of all options are going to increase. So remember, so you're trading options, you have the decision problem as to whether to be a buyer or seller of options. And the way you solve that is by looking at the eyeball chart, because the eyeball is an index of option prices. So you decided to be a buyer of options because you felt that your view on this was that this chart is going to move higher. Now, this could be wrong. Eventually, it might go lower. But, and you could have also decided that this is going to go lower. But you decided in this case to take the view that this is going to go higher. Okay, so that's why you have decided to be a buyer of options, because your view on the eyeball is bullish. So one of the reasons why you want to go for this kind of a strategy for buying longer dated options is you want to get maximum you want to get maximum bang for your buck. Okay, so you have gone long options because you are bullish on the eyeball. Okay, so remember what Vega is. If you go back to this, if we go back to our option price calculator, if you remember what Vega is, let's okay. So if you remember what Vega is basically the sensitivity of the option price. Is measuring the sensitivity of the option price to a, which is these two, okay, to a unit change or a 1% change in the eyeball, okay, the ball input to the OBM, which creates the same model output as the market price. So essentially the market is using this model and the market marks effectively marks up the eyeball by 1%. What will be the change in the option price? So that's what Vega is measuring, the sensitivity to the ball input. So if, what is your view? Your view was that the eyeball is going higher. And here what we are telling you is the first, again, this is a characteristic of options. Okay, this is always true, that longer dated options have higher Vega. Okay, so if you look at this chart here, which I've taken from here, this particular source. Okay, so if you look at this chart, it shows you that longer dated options have higher Vega. You can test it for yourself. You can tinker with the option pricing model, with the option valuation model, and check it for yourself. But if you increase the tenor of the option, the Vega will be higher. You can see the Vega. Vega is showing you the responsiveness of the option price to the changes in the eyeball. And these will be higher for longer dated options, because if you see here, these are 9-month option, 6-month, and 3-month. 3-month, 6-month, 9-month option. The higher the tenor of the option, the Vega is generally higher. Okay, this is just a characteristic of options. Nothing you can do about it, but you can allow this information to be used in your decision making. So what you're doing is, your logic is like this. Why am I asking you to be a buyer of long? If you're going to be a buyer of options, why am I telling you that if you're going to be a buyer of options, you should buy longer tenors? Because you want to get maximum bang for your buck if your view turns out to be correct. Okay, and so what is the view based on which you decided to be a buyer of options, the view is a bullish eyeball view. So if your view turns out to be correct, you want to get maximum bang for your buck. In that, you want the highest response. There's a little bit of a disturbance in the background, just ignore it. So if you want the highest bang for the buck, highest bang for your buck, so you are buying you want to buy options with higher vega, because what is the meaning of an option which has higher vega? Higher vega option means that if there is a unit change in this input, this option price will respond much more dramatically in the case where there's a higher vega than when there's a lower vega. So that's what vega is measuring. It's like essentially the first derivative of the option price with respect to the partial derivative with respect to the vol, which means just a rate of change. I mean, it's just respond. You can think of it as sensitivity analysis. If you change this input, how much does this output change? And this is measuring that. So higher vega means higher responsiveness of this price to a change in this. So that's why we are saying that if you have a bullish view on vol, then go for options which have a longer tenor, because longer tenor options have higher vega. So if your view is correct, you will get a higher bang for your buck. Okay, but obviously there is a flip side to it, which is that we are ignoring the flip side because we want to be, there's always a risk in everything. Okay, that let's make a note of this. If your view turns out to be wrong, you will also lose more money than you would have. I'm not writing all that. Than you would have if you had bought a I'm just writing it in not very good English. Just to make it clear to you. A shorter tenor okay. So if your view is, of course, if your view is wrong, you would lose more money as well if you have a higher vega options. But that's not how we generally operate in life. We don't assume that, we have some risk management plans, but generally we want to be positioned to make the maximum money if our view is correct. And then on the other side, we have some risk management defenses, like how much money we spend on the option premium, how quickly we react if the view is turning out to be wrong. So we have those defenses. So on the aggressive side, we try to play for to make the maximum money when we are right. Okay, so that's why the first part. So I've given you this rule which has two parts. When you're buying options, go for longer tenors, and when you're selling options, you go for shorter tenors. Okay, but even in the one part itself, you can understand both the important observations that go into the decision rule. In this decision rule, why do we have this decision? The first part is that longer dated options have higher vega, and you are buying options because you're bullish on the eyeball, and the vega measures the sensitivity of the option price to the changes in the eyeball. So if your view turns out to be correct, you want to make maximum bang for your buck. You want to be in longer dated options. They have higher vega. They will have a greater impact on your option price. So you'll make more money if your view is correct. Okay. So then let's. So this is what. So here, from here, you can understand that if your view turns out to be wrong, you lose more money. But here the idea is that longer dated options have higher vega, and so you'll make more money when your view is correct. Let me put that in here as a separate point, because that's an important way of thinking. Okay, so you make so you maximize your returns if So Vega is also called kappa. We can have that somewhere else actually. We can put that as a footnote. All right. So you maximize your returns if your view turns out to be right. In this case, has to be right. All right. So you maximize your returns if you're this is what we want. Okay. And so this is the idea behind the higher Vega. So you understand clearly the logic and the lower theta. So the other thing also that you will notice, you can check this for yourself. I'm just telling you this right now as a statement, but you can check it for yourself by looking at, we can do a check here itself. Let's look at the theta for this option. Okay. At the money option, the theta is say 0.05, 0.05, 0.04. For the call and the put. Okay, let's dramatically increase. This is 30 days. Let's like make it a 120-day option. Okay, let's see what happens to the theta. I'm not changing anything else. Okay, you see that the theta has gone lower because now it's 0.03 and this is 0.02. So it's gone down from 0.05 to 0.03 and this has gone from 0.04 to 0.02. So one thing that is clear is that longer dated options have lower theta. Okay, so that's one of the things that you can see. So this is, you can check this for many other combinations. So longer dated options have lower theta than shorter dated options. Okay, this actually should be put here because this relates to the Vega part. This should be put here. Don't really want to put it in the same bracket, but we'll do it. This should be a second bracket. All right. So this is because longer dated options have higher Vega, so you maximize your returns. Okay, let's break this statement down properly so that it's easier for you to understand when you read it. So you maximize your returns if your view turns out to be correct. Okay, and if your view turns out to be wrong, you'll lose more money than if you had bought a shorter tenor option. And we'll put the and here, and we'll write it like this: lower theta and longer dated options have. We'll put this. We'll break up the structure of the sentence. Higher Vega than shorter dated options. So these become two separate sentences that are complete in themselves. Okay, so you see, so the rule that I'm giving you, selling options shorter tenors, buying options longer tenors, there are two reasons for that. They are connected to Vega and theta. And first we are explaining the Vega part of it, and we are putting in a complete sentence there. And then we are breaking it up with an and. Okay, and then we are saying longer dated options have lower theta than shorter dated options. Okay, so why is this? And so what is the meaning? What is the implication of that? Why longer dated options have lower theta? So when you're long options, the theta is right. So you can see the logic here. So the reason here is that any long option position, this is true. Okay, that in any long option position, you will see these are actually these Greeks are for long positions in these options. So the theta is negative for both. So if you can see here, what happens is that if you have any long option position, you're always going to lose money. long options, theta is eating away your P&L on a daily basis. So if you're playing the long option strategy through longer dated options, you have lower theta. That is the main thing. You could have played your long option strategy with shorter dated options also. You could have gone here. You could have chosen shorter dated options, December 4th or something, but this would have much higher theta than if you go for a longer dated option like this. So that's why, and because you're going long and you're going to be losing money on theta anyway on a daily basis, so you might as well lose at a lower rate than lose at a higher rate. Okay? And we'll show you this chart, which we had already showed you once, because Siddharth asked a question about this earlier, a couple of sessions earlier. So what we are showing you, the second reason that we are giving you is that when you are actually buying options, when you're buying options, your theta should be will be eating away at your P&L, and so therefore you should buy longer. You should buy longer dated options, because at least you can't help the fact that the theta will eat away at your P&L, but at least it will have a lower theta, okay, than a shorter dated option. So that's what we're talking about here. And let me just show you the chart. Here. So here's the chart. Maybe I should reduce the zoom a little bit. You can see the whole thing in one view. Maybe I should reduce it a little bit more. Yeah. Now you can see this is taken from this particular website. Now this is the map of theta. Okay. For generally this is true for at the money options. You have a slightly different type of curve, but generally it will always be true that when you have higher time to expiration, the theta will be high. Remember, theta is always negative. So this is on the bottom side of the coordinates. Okay. So here you see that the theta is much higher when you have the theta is much higher on the negative side, as the time to expiration becomes shorter. Okay, so very short time to expiration. The theta starts to, as you get closer and closer to expiration, what this chart is showing you is, you should remember this chart visually, that if you plot the theta, and remember this is always on the negative side, okay? So the y-axis here, the negative side. So this is always negative, theta is always negative, but at least when you have a long time to expiration, it's not so negative, okay? It's not so much below the zero line. But as you get closer and closer to expiration, as you come to 0 days to expiration, the theta starts to become very sharply negative. You can also test this. You can test it for yourself on using the pricing model, okay? But it will become like this. So this is the graph of theta for at the money options, and more or less not very different from for out of the money and in the money. So therefore, and since most of the trading happens in at the money options, so therefore we say that you should, when you're selling options, try to sell shorter dated options, because remember, when you have a let's look at the long side first and close it out. So if you have a longer term option position, long position, then you will still lose money from the theta every day, but you will at least not lose that much money. Whereas if you had bought a shorter dated option, then as it comes closer and closer to expiration, because remember, every day, every option that you have bought comes 1 day closer to expiration, and nothing you can do about it. It only goes one way. So you will start to lose money at a very rapid rate. So that's why you should not buy options which are very short dated. And therefore on the flip side, and if you go to the flip side, which is that you want to, when you're selling options, you want to be selling short dated options, because when you're on the flip side, these are for long positions. So they will be reversed if you have a short position. Okay. So if you have a short position, then what happens is this becomes positive, because it's negative times this, so it's positive. So you're benefiting from the theta. So on the short side, you want to have an opposite of attitude. You want to be selling short dated options, because then you're picking up very rapidly, you're picking up money based on the theta, because the theta is becoming rapidly very large negative figure. So therefore, every day you're picking up profits at a high increasing pace. So that's why you want to be a seller of short dated options, and you don't want to be a seller of long dated options, because the main benefit of being an option seller is this. The main benefit of option sellers is to get this, of course, also to get benefit from the Vega. Okay, if you are right about the drop in the eyeball and the eyeball actually drops, you can actually get money from Vega as well. But mainly option sellers try to make money from theta. So therefore, if you have very sharply increasing theta in the short dated options, you can benefit from that. And when you don't want to be selling longer dated options because the rate of increase of your profit from loss in the value of the option due to passage of time, this is not very dramatic. So you're not really making much money here. As an option seller, you want to be located here. So that's why you see this advice: buy longer dated, sell shorter dated. So very simple rules actually, but it's just we want to be clear about these rules. They're very simple rules, but there's a lot of theory that goes into the creation of these rules. So it's very important that you understand that. Okay, so it's a very simple rule that we have for as far as choosing the expiration date is concerned. Okay, you want to be choosing selling options, shorter tenors, buying options, longer tenors. Okay, so longer tenor, higher Vega, maximize your returns if your view turns out to be correct, and also protect yourself by not having too much very high theta. Okay, so therefore you protect yourself while you try to take advantage of this. So these are the two charts that I showed you: that higher Vega for longer dated options and lower theta, okay, for longer dated options. So therefore, those two combinations, these are just properties of options. You can't do anything about them. But in arriving at your strategy, you are trying to take advantage of the properties of options. That's what you're doing. Okay, so that's why you have this situation, and that's why you have this kind of rule. All right, and selling options lower, shorter tenors, buying options longer tenors. Okay. Now at this stage, I've given you a long lecture. Anybody has any questions? Now, Vipul, we'll start with Vipul. Now, Vipul, does it answer your at least some of your questions which you had earlier?
Yes, sir. Sir, it answered. Yes, sir.
Okay. And
That's
that last part, when you were mentioning that, I didn't really understand what you were mentioning.
Sir, I can explain you, sir. Like, sir, you, I have discussed with you that when the expiry date is near, the premium will be reduced from the option and the price go down.
Yeah.
At that point of time.
Yeah.
And sir, in that particular case, sir, on expiry date, like on Thursday, the price goes higher in time frame of 1 to 2 hour. Basically, sir, after 1 p.m.
Price went higher.
Yes, sir. It came from 20 rupees to 420.
I mean, the underlying asset price.
Sir, option price, sir.
Okay. All right. Okay. So let's do one thing. Let's discuss this a little further. So you're satisfied in terms of the theoretical material that I just explained. That gives you
Yes, sir.
a understanding of what happened to you.
Yes, sir. Yes, sir.
Okay. Good. Okay. Fine. So all right. So we'll just continue with this later on. If necessary, we can ask again at the end of the class. So everybody else is clear. Everybody else, let me throw open the question to the whole class, because this is important to understand what I just explained. I taught you several things here. I taught you a rule. I focused you on one of the important decision problems when you're trading options: which expiration date to choose. Okay, once you've decided to be a buyer or seller of options, you've decided to be a buyer or seller of calls or puts, then which expiration date should you choose? That's based on whether you've decided to be a buyer or seller. Sellers, shorter tenors; buyers, longer tenors. Now, this is just, don't memorize this, okay? More important to understand what is the thinking behind coming out with these rules, okay? So that is based on Vega and theta and the characteristics of options. So all this stuff that I explained right now, anybody has any questions, any clarifications?
Sir,
Yeah.
So for selling short-dated options, you said that you're picking up profits at an increasing pace. So I didn't understand the reason behind it.
Okay, so the point here is that when you're selling short dated options, so have you understood this point, that the point that I established here, this is just a characteristic of options, that the shorter dated options have higher theta and longer dated options have lower theta. We just showed you that. You see this option has 120 days to expiration. It has a lower theta, it has a theta of 0.03. Let's just look at the theta of the call, it's easier to understand. Okay, so this has a theta of 0.03. Okay, I'm ignoring the sign. And if we change this to, let's say, a 10-day option, look at what happens to, if nothing else is changing. Okay, I'm just changing the theta. See what happens to the theta, it becomes 0.09. So the theta becomes triple. And it's a negative if you have a long position, all right? So the first characteristic of option you have to remember is what is the reason for this rule? This is a characteristic of options that longer dated options have lower theta and shorter dated options have higher theta. Okay. So based on that, if you're going to be a seller of options, remember the main reason why you sell options, there are two reasons actually. One reason is that you have a bearish view on eyeball, okay, which is what we have given you in this framework. That if you have a bearish view on eyeball, you look at the eyeball chart and you feel this chart is going to go lower, then you have a bearish view on the eyeball chart. This is for the future. And then obviously if the eyeball is going to drop, prices of options in general will drop. So you want to be a seller of options because you see option prices dropping. So that's one of the major drivers of coming out with a short option strategy. But the other major driver of option selling is short option strategies is this factor, that anytime you go short, because these are for long option positions, these Greeks. So they have negatives. So negative theta is for long option positions. So if long option positions have negative theta, then if I go short options, I should have positive theta, right? So therefore, that's the characteristic of short option positions, is that they have positive theta. So you know that if you go short any option, every day you're making some amount of money. If nothing else moves, obviously if other things start moving, then things may not work out for you. But if nothing else moves, you know one thing that's guaranteed to happen in life is that if you sold an option today, tomorrow this thing is going to 9. Day after it's going to 8. That is guaranteed. So every day there'll be one low, this value will go down by 1. And therefore, because of the theta, you will benefit from that, so that your short option position will pick up some amount of money. In the sense you would have sold something at maybe 35 and now it's gone down to 34. Okay, so there'll be some amount of profit on your position. So that's the other major consideration in going short options. Okay, one is a negative view on eyeball, and the other is that the desire to profit from the positive theta of the short option position. And so the reason we say short option positions, we know that they are seeking to profit from the positive theta. So the reason we say that in that case, if you're going to be short options, go for, seems to be too little. Yeah, so the reason we are saying this is that when you want to go for short options, you notice that, so there are two levels of understanding here. One is that long option positions have negative theta. So this is shown for long option position, this chart, okay, for long option position. That's why it's below the 0 line, okay, the theta is negative. Now, but that's the first level of understanding, that long option positions have negative theta. So short option positions will have positive theta. You have to flip it around. Now, what is the nature of the behavior of theta? It's not so simple. It's not constant across expiration dates, the tenor of the option. If you look at longer tenor options, the theta is quite low in absolute terms. But if you look at very short tenor options, the theta is very high in absolute terms. So that's why, because you know that as a seller of options, you're going to be benefiting from theta. So you want your benefit to accrue at a very high rate. That's why you want to be selling options in the short tenors, because you know that these options are going to be losing value at a rapid pace. Okay, so obviously everything is dependent on the fact that nothing else moves. When you do your plans and calculations, you assume that nothing else moves, but in real life, of course, other things can start moving. So you may have, this will move in your favor, but this may go against you, okay, or this may go against you. So you could still get hit. But generally when you plan, because you can't plan for everything changing at the same time, then it becomes too confusing. You know, it's not possible to plan like that. But you plan based on everything else remaining the same, and your factor is going to move in your favor. And then you have some backstop risk management plans. So that's why you say that when you're selling options, you go for shorter dated options. Does that answer your question?
Yes, sir.
All right. Yes, Aman, what is your question?
Sir, how long or short period we will select for our project?
So yeah, I don't want to give you a mechanical thing, but as I said, as a guidance, you can take it as, generally, if you really want to go short dated, and your project is anyway also very short dated, but that won't affect it because you can still have closing. You'll be evaluated based on your open position value. Even the option, you can actually trade even a 3-month option. And when you close your position, you'll be closing based on the market value of that. So a short answer to your question is, I think I would say go for 15 days or less if you're a seller of options. That is generally true, not just that. That answer is not affected by the tenor of your project. Your project is 4 weeks, but in general also, I would say that for any kind of option trading strategy, if you're going to be a seller of options, go for 15 days or less.
Okay, sir.
So that's a broad guideline, but of course you can go for 25 days also if you. It depends because there are other factors also involved. Okay, it's not just the because you're choosing expiration date, and then there's you will have other dynamics also involved, as we will see when we go into the next factor. But yeah, you can work with 15 days. So if you're selling, go for 15 days or less tenors, and if you're buying, then go for 1 month or more. That's your broad guideline.
Okay, sir.
We can write that
Thank
here.
you.
We can write that here in the note for today. Okay. I think I might have written it. And actually save a point. So this, obviously the English is not very good, but you understand what we are saying. So I'm just making a note of this against this, and we'll maybe put this one more time. We have not put this framework link further down. What we are discussing today is actually so we are discussing the 2 decision problems, which are the expiration date and the which expiry and which strike. These 2 is what we are discussing today, right? So we'll put that also here. Right. Okay. So which expiry date to choose? I hope now we have some clarity on this. Pretty simple. Actually, the rule itself is very simple, but I didn't want to just give you the rule to memorize in 5 minutes, because you have to understand, really the understanding of option trading comes from understanding the theoretical, underpinning for the choice of strategy. Why do we have this kind of rule? Because of all the theory that goes into the devising of the strategy, relating to the understanding of vega and theta, etc. So it's a very complex field, option trading. So I would encourage you to read more, read the textbook that I've given, but more importantly, I would say, textbook you read only the parts that I have referred in the chapters. I have referred to chapter 10, chapter 11, whatever. I've referred to several sub-chapters. But I would say the most important book to read if you are serious about option trading is the book by Sheldon Nattenberg, which you will find in your finance reference. Okay, that's a very good book. That's a practitioner book. So you want to be reading in finance as far as possible. You want to be reading material written by practitioners rather than academics. Okay, so therefore you read that. If you want to get serious about option trading, you read the material I've given you. You read and then you read the Nattenberg book. It's a very good book. Okay. All right. So next point is any more questions at this stage on the point that we have just discussed, choice of expiry date? Okay, good. So we'll go on to our next decision problem that we have to solve under the buy-sell decision problem. So under buy-sell in option trading, we have 4 decision problems. In the case of spot trading, we only have 1 decision problem. What should be my buy-sell bias? Just look at the chart of Twitter, decide if Twitter spot equity prices for Twitter are going up or down, and then buy. That's it. Only 1 decision problem. In the case of options, it's much more complicated. We have 4 decision problems. I have to decide whether to be a buyer or seller of options. I do that by looking at the eyeball chart. I have to decide whether to be a buyer or seller of calls or puts. I do that by looking at the underlying asset chart, asset price chart. And for that, I use this framework. Then additionally, I have to decide expiration date and strike. So there are 4 decision problems under buy-sell bias in the case of options. In the case of spot contracts, there's only 1 decision problem. So just grabbing that. And now we are coming to the 4th of those, which strike to choose. All right. So let's look at what we have here. So we stop there. So the point I mentioned here is that the process of forming views is not discussed here. If you remember some sessions ago, Utsav was talking about the choice of TA and FA is also a decision problem. Yes, that is true actually. But we are actually not even going into that. That's at several levels down the pyramid. We have to also take a decision as to whether we want to be a user of TA or FA. But we are not even discussing that. We are going to be discussing that as a separate problem. At this stage, we are not even discussing that. We are leaving it to you to decide how you want to solve this. What is the process for forming the views? Because I'm talking about forming views. Forming a view on the eyeball, forming a view on the underlying asset price. So Utsav's question is relevant in that, how do I form the view? Do I use TA? Do I use FA? And within that, there are different methods. We are not going into those discussions. I'm leaving it to you. But in general, as a shortcut, you can always look at it like a surfer. Just keep it simple at this stage because we don't have time to teach you all the theory. And that's nothing much we can do about that lack of time. So at this point, to make it simple, and this is not a very frivolous strategy, this is a very reasonable strategy. Look at it like a surfer. Use your instinct and look at this chart and see that it's behaved like this. Now, which way is it going to behave? How is it going to behave now? Think of it as surfing waves. So you can do that. And that's a very good strategy actually to try and develop your instinct about markets. So do that. And so we're not discussing that. I just wanted to mention that part of the note. So we're going to choose about how to choose the strike. The choice of strike is basically like this, that we have, maybe this is too much. 140 room is too much. Okay. So you have the choice, as far as the choice of strike is concerned, okay, that you have, it's also partly related to expiry date, but expiry date, you go with what we have given. But in the case of choice of strike, you have also some other considerations like volume and open interest. You'll see this even in your IB TWS, which I have not opened today. But in TWS also, you'll find that when you have this kind of a display, you can see the volume and open interest figures given and updated on a live basis. All right, so open interest, you don't worry about so much at this stage. We have not explained it. But generally higher open interest means more liquidity, and more liquidity is better than less liquidity in general. Okay, it's always in your situation, more liquidity is better. So we want to see higher open interest and we want to see higher volume. So one of the ways we make the decision is that in choosing strike and expiry, and now we are discussing more specifically just strike, we want to have a general liquidity filter, okay, and we are using volume and open interest as indicia of liquidity. Okay, these are indicators of liquidity, and open interest means that it's a number of outstanding contracts, but you take it as higher open interest is better and lower open interest is bad, same as volume. Okay, so generally I want to go for maturity and strike, which have for any maturity, you will notice that we are looking at Jan 15 right now. You notice that the vol is, even if I look at calls alone, that different strikes, I'm looking at different volume figures, different open interest figures. Okay, you'll see here that it's very high near the at the money. This is where the concentration is. In option trading, you'll find that this is a feature of option trading, that the concentration of volume and open interest tends to be very close to the at the money. The underlying right now is 210, just above 210. So you see that there's maximum concentration here in terms of volume and open interest. Okay, this is just a characteristic. That's why most people also tend to trade in at the money options. Okay, there are certain other stable characteristics as well. So most of the, as just generally a fact of life, that most of the trading happens in at the money options. Many of the strategies are also based on at the money options, etc. So this is one guide in choosing strike and expiry date. The second is there is a part where I've talked about, yeah. So let's look at the strike part. This is basically we've talked about a little bit on the expiry date, volume and open interest. Okay, and we've talked about this. So volume and open interest is a general point, but let's talk now about specifically about strike, because strike there's only one important decision. So there is some element in the case of choice of strike. You have one element which is strikes. And let's have something here, choice of expiry date. Yeah, so choice of strike is, there are three considerations, okay? One is your directional view on the underlying market, okay? So which is this, when you're trading SPY options, what is your directional view on this? Because this is where we go back to the point that Utsav raised about the moneyness of the options, okay? So if you have a view that this is going to go up sharply, so this is maybe right now the SPY is around 360, 358, and if you feel this is going to around 400, all right? So one of the considerations that will drive your choice of strike is this, that I want to choose, okay, if I feel, okay, this is now actually MSFT. We can look at this, maybe we can change this to, I think easier to change this. I hope there is no data, sometimes you have bad feed. Like in the case of, I think Apple, you have bad feed because they haven't adjusted for the stock split. Okay, so I look at Microsoft, okay, and I look at the eyeballs. Let's say I'm bullish on the eyeball. I think it's going up here. Right now, in terms of choice of strike rate, I see option prices are now around 212, okay, 210. So if I feel, let's say that Microsoft is going to maybe 300 very quickly, and by Jan 15, it'll be at 300. All right. So one of the things that will drive my choice of strike is my view on the underlying asset price. So if I feel that this is going to go up to 300, I may choose a 300 strike call, okay, which you can see here. It's a low price because it's very out of the money, deeply out of the money. But by the time it gets to expiration, it will be close to at the money. There'll be higher volume in that call. So these are some of the considerations. Okay, I don't want to spend too much time on this because this is not a very important consideration. Then you have different vega for at the money, OTM, and ITM. Okay, so there is a so in this also some point about moneyness is important. Here also it's important that you have different vega for ATM, OTM, and ITM options. Okay, so this is the second side of an in-depth consideration. So that's another thing that comes into. I'm just giving you the full picture of everything that goes into it. Into the decision making. So it shows you that it's a very complex decision making framework. But mainly it's this, okay? Mainly is this, okay? So I showed you that different, again, notice generally. I've qualified it with generally, okay, so that I'm not making an absolute statement. Sell options with higher eyeball, buy options with lower eyeball. Very simple, because I have already told you that eyeballs are an index of option prices. So higher eyeballs means higher prices and lower eyeballs means lower prices. So remember, when determining whether options are cheaper or more expensive, we don't look at the absolute premium. So what you don't get in the Yahoo Finance display is these are the premia, call option premia, put option premia, but you don't get to see the eyeballs. So when you decide whether some particular option is cheap or expensive, you don't decide that by looking at the absolute level of the option premium. You decide that by looking at the eyeball figures, which you can get when you look at the TWS. Inside the TWS, when you mouse over the strike, you will be able to see the option, the eyeball associated with that premium. And that is how you decide whether a particular option is cheap or more expensive. Okay. So therefore, the most important rule for choosing strikes is, of course, there is an element of you have to be conscious of volume and open interest. You have different vega for different ATM, OTM. You have your directional view on the underlying market, which affects many option strategies, which we will do later. But the most important reason, because if I give you all these, then you'll get confused and you'll say, which one should I use? Okay. So I'm telling you very clearly, use this. Okay. This is the most important reason, because it's very simple. There's nothing complicated here. If you're buying anything, you want to buy it cheap. If you're selling anything, you want to sell it when it's expensive. So higher eyeball means more expensive options. Lower eyeball means cheaper options. So when you're buying, you buy cheaper. When you're selling, you sell higher, more expensive, dear. Okay. So therefore, and also remember that cheap or expensive is determined by the eyeball level. So that's why you have to use the TWS. And that's why I use software like this. It shows you the value of this kind of software. So when you're having discussions, I would say when you're having discussions with your buddies who are in other business schools, one of the things you should discuss with them is that when you're trading options, do you use a software where you actually get to see the eyeball level, or do you even decide just to buy options? So even test their knowledge on whether they know this aspect, whether option premia are to be expensiveness or cheapness of options is to be judged by looking at option premia, or do you look at the eyeball? And is the software that they're using, are they giving them indications of eyeball as well, or is it just looking at premium? So these are all things which you have to look at. So this is why I'm explaining why we use a software like TWS, because it gives you the eyeballs also next to the option premium. So that helps you to decide which strike to choose. So overriding rule for choice of strike, I would say, these are also important. You will see it later when we do option strategies. But the overriding rule for choosing strike is higher eyeball. Go for, when you're selling options, go for strikes which have higher eyeball. Okay. So you look at, I don't have the TWS opened here, but you will, what you will do in the TWS, you'll have this kind of view. You will run through the strikes. First, you'll choose your lock into your expiration date, finish that decision problem. Then you will move through the strikes. You will mouse over the option premium and you'll see the eyeballs. And then you'll see which one has higher eyeball. And then you're going to choose that. If you have higher, if you're going to be a seller, you choose the one with the high eyeballs. And then if you're going to be a buyer, you can choose the one with the low eyeballs. Okay, that's how you decide. Of course, if you want, you can have some element of balancing. Maybe you don't want to go for something with very low volume, but in general, it's safe to go for just plain apply this rule, because I want to keep it simple also for you in your first application of option trading. All right. Okay. So that's the end of your class, and I won't detain you. So the class is dismissed. You can leave. Mithali, I'll just speak to you briefly. And okay, before I speak to Mithali, does anybody have any kind of conceptual question at this stage regarding what we have discussed, or even anything from before?
No, sir.
Okay.
No, sir.
Okay. All right. So you guys can leave. The class is dismissed. So
Thank you.
Thank you, sir.
yeah. So what we are going to do with you is I'm trying to fix your problem with the broker. Mithali, you're there, right?
Yes, sir. Yes, sir.
So don't try to log in right now. We are trying to fix your problem with the broker, and I'm going to